Hi. Let's learn about health savings accounts, HSAs. A health savings account is a tax-advantaged account created for or by individuals covered under high-deductible health plans, HDHPs, to save for qualified medical expenses. Contributions are made into the account by the individual or their employer and are limited to a maximum amount each year. To qualify for an HSA, the taxpayer must meet eligibility standards established by the Internal Revenue Service. The maximum contribution for an HSA in 2022 is $3,650 for an individual and $7,300 for a family. Individuals age 55 or older can make catch-up contributions of an additional $1,000 to their HSAs. HSA contributions can only be made in cash, and individuals with an HSA can use the funds to pay for qualified medical expenses. HDHPs have higher annual deductibles and lower premiums than other health plans. The minimum deductible required to open an HSA is $1,400 for an individual or $2,800 for a family in 2022. Once the annual deductible is met, the plan generally covers additional medical expenses. Individuals with an HSA can withdraw money to cover these out-of-pocket expenses. Employer and individual contributions to an HSA are excluded from the employee's taxable income. Distributions from an HSA are tax-free if the funds are used for qualified medical expenses. However, individuals must be a good candidate for an HDHP to benefit from an HSA. HSAs also come with filing requirements and a record-keeping burden that may be difficult to maintain. Amounts withdrawn from an HSA aren't taxed if used for qualified medical expenses. If distributions are made for anything other than a qualified medical expense, they are subject to income tax and an additional 20% tax penalty. However, once an individual turns 65, the 20% tax penalty is eliminated, and only income tax would apply for non-qualified withdrawals. Contributions made to an HSA do not have to be used or withdrawn during the tax year. Instead, they are vested, and any unused contributions can be rolled over to the following year. HSAs are portable and can be transferred to a surviving spouse tax-free upon the account holder's death. While both accounts can be used for medical expenses, some key differences exist between HSAs and flexible spending accounts, such as the maximum contribution limits. Here are 4 key takeaways. 1. A health savings account, HSA, is a tax-advantaged account designed to help individuals save for qualified medical expenses. 2. No tax is levied on contributions to an HSA, the HSA's earnings, or distributions used to pay for qualified medical expenses. 3. An HSA, owned by an employee, can be funded by the employee and the employer. 4. Contributions are vested, and unused account balances at year-end can be carried forward. Hope this would help. Thanks for watching.